Common psychological mistakes that traders often make. We're looking at the 5 common psychological mistakes in trading. People normally think that technical analysis is always the thing. That no, psychology is also paramount when it comes to trading the financial market, and this psychological mistake is what traders often overlook, but it's so crucial. If you don't get aware of this psychological aspect of trading, you fall into this mistake several times and you won't recognize that it might be the reason for you not being profitable in the market. So we'll be looking at number one: overconfidence. Traders often become overconfident in their abilities, leading them to take more risks and make bigger bets than they should. This can lead to significant financial losses. This overconfidence of a thing often comes whenever you have a winning streak. It's been long you lost your trade, so you now feel so invisible in the market, and you feel that your strategy is the holy grail, is 100% accurate. This leads you to being overconfident, and it will make you to take bigger risks in your positions. And when you take bigger risks, peradventure you lost the trade, and you see your losses will be huge. So overconfidence is a very big psychological mistake that traders often make, and you need to avoid it. So another one is confirmation bias. Traders tend to seek out information that confirms their existing belief and ignore or downplay information that contradicts them. They can lead to poor decision making and missed opportunities. Most of us, we have our strategy, we have our trading plan, but some people will always want to look for extra confirmation on social media. Maybe you've done your analysis and you see, okay, EU is going down, but you want to look at the social media and see what other people are saying, and then you go, one guru there or one idol there is predicting a buy on EU. Meanwhile, your strategy is telling you to sell. You now change your bias. This is a common psychological mistake. You should be able to stick with your rules, stick with your strategy. No matter what you are seeing online, you should be able to stick to your rules. Another psychological mistake that we'll look at is loss aversion. Traders are often more motivated to avoid losses than to achieve gains, which can lead them to hold on to losing trade for too long in the hopes of a turnaround. This can result in even bigger losses. You see, this psychological mistake is also tied to emotions. Bringing hope. When you are in a losing position, you have to cut your losses and move forward. But traders tend to avoid losses. But in real time, profitable traders are not afraid of losses, because the best losers win. If you understand the best losers win, you'll be able to know that you running away from losses, or you trying to avoid losses, is not the right way to go to it. You need to embrace losses in this game, because that is the way to attain profitability. Best losers win. Another psychological mistake that we're looking at real quick is herd mentality. Traders often have a tendency to follow the crowd and make decisions based on the actions and opinion of others. This can lead to irrational behavior and a lack of independent thinking. Like I said earlier, you need to stick to your rules. Forget about what the crowds are saying. Forget about what they are posting on the social media. Forget about what so set of people are saying. Your trading plan is what you should listen to. You are not listening to others. Rather, your trading plan is what detects when you buy, detects when you sell. Anything outside of your trading plan should be neglected. Another aspect we'll look at is emotional trading. Traders can be influenced by emotions such as fear, greed, and impatience, which can cloud their judgment and cause them to make impulsive and irrational decisions. It is important for traders to manage their emotions and make decisions based on logic and analysis rather than emotional impulses. When you have been fearful to open a position, you've seen your setup, and your strategy is saying buy, and you are afraid to buy. You see, this is emotional trading. Like I've always said, you should be able to stick to your rules. If your strategy says buy, buy. If it says sell, sell. You are not to allow emotions like fear and greed most of the time impatience is a very big problem on the side of traders. Some of us out there, some of traders out there might be looking for a holy grail, but you might not know that your impatience is what is hindering your profitability in market. So as a trader, you need to be patient. Don't make impulsive decisions, but your decision should be based on logic and analysis. That is why you should always stick with your trading plan. Your trading plan should be your best friend. One solution that can help traders overcome most of these psychological mistakes is implementing a well-defined trading plan. A trading plan sets clear rules and guidelines for entering and exiting trades, managing risks, and following a disciplined approach. Following a trading plan can help traders mitigate the impact of biases and emotions on their decision making, ensuring a more systematic and objective approach to trading. So guys, thank you very much for sticking to the end of this video. Please always like and subscribe to this channel.